everyone, and welcome to my webinar, the tax planning opportunities, what you can still change prior to the end of the tax year, which is coming up in a few weeks' time. My name's Mitch Young. I'm the co-founder of the Fusion Consulting Group, and also a lot of you will know me from my social media as Mitch the Taxman. So this webinar is being brought to you by my company, which is the Fusion Consulting Group. Just a very brief introduction to us, whilst of course you are on today's webinar to talk about tax. What we've created is essentially a professional services group where we have in-house a tax advisory business, an accountancy business, wealth planning, legal, recruitment and consulting, all within our company, with the idea being that for an entrepreneur or a family, they have all their core advisors in the one company, all discussing the client's matters to ensure that they achieve greater efficiency and speed in what they're trying to do. So we're the first of our size to actually have this fully set up. We have 5 offices across the UK. I'm based in our North London office in Finchley. Okay, so today's theme is going to be around tax planning. What can be done before the end of the tax year? We're going to be covering areas of property. We're going to be covering areas of business owners. We're going to be covering inheritance tax and some other little bits in between. So the tax year end matters because generally there's tax rates and tax relief changes which resets on the 5th of April every single tax year. And this tax year is no different. So what we tend to see in practice is that clients get tremendously busy, either running their business or their families, and they forget to actually invest the time in tax planning prior to the year end. So they tend to miss out on being tax efficient for that tax year. And they always say, okay, well, I'll make an effort for the next tax year to be more efficient. But this tax year in particular, there are some major structural changes to big reliefs where, it will be important for you to consider whether anything can be done prior to this tax year. And we'll go through those in a bit more detail as we work through the slides. So hello from everyone from across the UK and the world who's joining us today. Some nice messages coming through, building a nice community. Okay, so we're going to begin with business owners and just going back to basics in terms of, some things that you should consider prior to the year end. We know nowadays as a business owner, extracting monies out of a limited company is quite challenging. There's no magic formula. We know dividends are now subject to tax, obviously, and those rates are increasing. We know, of course, there's PAYE, national insurance has increased. So really, it's about analysing as you get towards the end of the tax year, what your distribution model is looking like as a director and shareholder of a limited company, and what would be the sensible adjusted net income for the April tax year end. Of course, what tends to happen in reality is that a lot of business owners will have a slightly different business year end to the actual tax year end. So it'd be important just to not focus on the actual company year end, but look at what distributions you've taken up to the tax year to ensure that you've sheltered the right amount, the right mix. And essentially, it will just be about modeling which works for your business. A lot of our clients have actually moved away from the traditional small salary up to the personal allowance or the national insurance threshold and the rest is dividend, to more of a salary dividend split. Because of course, with a salary, it acts as a corporation tax deduction as well. So it will really be dependent on business by business. So I'd recommend working with your accountant and to work through a couple of different scenarios which works for you. But the starting point will be, what have you extracted in this tax year and what is those levels? Because as we know, that £100,000 level, when you go between 100,000 and 120,000, you lose your personal allowance. It becomes an inefficient amount of tax, around 68% effective tax rate throughout that period. Some basic planning may include spouse and using your spouse or civil partner, of course, and pensions. Clients have said to us, with pensions now coming into inheritance tax, is it still worth looking at pensions via a limited company? And I would say, yes, it's still worth considering pension contributions. Remember, with a pension contribution, it will act as a pure corporation tax deduction from your company accounts. So if there are reserves, if there are spare money, it's that money which is going into your own pension pot still. So it's a way of giving money to yourself, to your pension, and doing that in a tax efficient way. And there are various different types of pensions. So it'd be important you sit down with a financial advisor and actually understand the options around pensions. A lot of our clients who have historically invested in property, real estate, don't particularly like pensions. But ultimately, when you actually break it down in terms of what the pension mechanics can offer, particularly around SASs, where you can maybe invest some of the monies in commercial real estate, loan money back to the company within that type of structure, then it is worth exploring. Of course, there's an annual allowance of £60,000, can go back 3 years as long as you have regularly or previously contributed to a pension scheme. One thing to consider around the company year end as well is what to do with excess cash, and potentially looking at reorganizing your share structures.
Yeah.
So what we've done a lot of with our clients is actually looking at the future of their business, and instead of having 1 or 2 limited companies owned by the shareholders individually, we've looked at potentially consolidating within what's called a corporate group with the use of a holding company. So if you're in a position where your trading business has excess cash, and obviously you don't want to extract that personally because you'll be subject to 39% of a dividend, then it may be the time where you consider inserting a holding company, which essentially owns the shares, takes over the shares from yourself, and then that will be a corporate shareholder. Once you've established that position, you can then extract the cash into your holding company and then look at reinvesting in another business or another company. And, that might be something to look at. Some other reasons as to why you may want to look at restructuring at this point in terms of, a corporate group would be the separation risk. So what I mean by that is that if you have, say, one trading entity that's building up reserves, you may have invested in property within that or some investments in that. It's important to actually look at safeguarding the trading business as a business. And then you may want to have another entity within the group, which is more geared towards investments. This will protect things like business property relief, which I'll come on to in a separate slide. That's the main relief available when we talk about inheritance tax on trading businesses. Another great point is to the segregation or the reorganization of a business is the potential sell or exit of the business. And obviously we'll come on to business asset disposal relief in a moment. But essentially what could happen is when you are in a formal corporate group, if you sell your trading business, those proceeds could then get transferred into your holding entity for continual investment. The sale of the trading business, as long as it qualifies within the corporate group, that transaction could result in no tax, and then you just reinvest the proceeds continually within your group. Of course, if you want to extract the money personally, there is always going to be a tax charge. We've spoken also about briefly about business property relief. A lot of reorganizations are happening at the moment because of the inheritance tax situations. So it may be the time to reorganize your business structure, look at maybe the holding entity, and then potentially the gift of shares to other family members, or indeed a trust, which we'll come on to a bit later. So lots to consider if you're a business owner prior to the year end, prior to April. Pretty much right on the money in terms of actually can you achieve all of this prior to April. So if you haven't spoken to your accountant or tax advisor, I would get on with that if this is something as a business owner you wanted to look at prior to the year end, because the actual formal establishment of the corporate group takes a number of different stages. Planning, to do the planning, you've got to get clearance from HMRC, you've got to do all the legal transfers as well. So I would move forward with that pretty swiftly. Okay, just some basics which we've discussed anyway. Obviously, the income tax thresholds are on screen right now for you to consider. Some of the things that you may want to additionally look at is around that £100,000 mark. Just be aware, obviously, when you get to between £100,000 to £125,000, the personal allowance starts getting chipped away at. So once you get over £125,000, the full personal allowance gets removed. So if you're straddling between that sort of tax band, you want to ensure that you're being as efficient as you can be. And then one other thing to mention on this is around the child benefit charge. So this is essentially if you or your partner earn above £60,000, increasing to £80,000, then if you also receive child benefit, you need to start paying back the child benefit, which essentially when you get to £80,000, you have to pay it all back via self-assessment. So it may be worth looking at that if you are in receipt of child benefit and you are a sort of a higher rate taxpayer, for you to consider there. Some of the things that can be considered in terms of basic income tax planning is around, we've mentioned pension contributions already, gift aid donations. So if you are gifting to charity and they do qualify for gift aid, keep a note of all of that, because essentially what you gift extends the basic rate band. So the more you gift, the more from £50,000, the basic rate band will be extended. So that means you'll be paying more of your income at 20%. So a lot of people don't realize that. Salary sacrifice, well, we know there's some changes happening there. There are, if you do have obviously accessible income or excess income, you can look at with your financial advisor tax efficient investments such as SCIS, EIS, VCTs, where your investment would qualify for some income tax relief, and which you would claim on your tax returns as well. Okay, so we're moving on to talk about business property relief. And this is one of the key changes which is coming in after April. You probably would have been following this and the budgets of last year, and it's quite amusing. Well, not really amusing for me and my clients, but essentially the constant changes of the Labour government. I'm not going to get too political. So what happened was that in the budget, it was announced that business property relief was going to change. So previously, one would receive 100% business property relief on the transfer of shares of a trading business on death. So, if your parents had a trading business and it was worth, £5 million, for argument's sake, from an IHT perspective, IHT calculation perspective, the £5 million would go into the IHT calculation or probate, and then you would get, assuming it qualifies as a trading business, you would get £5 million of tax relief. So there wouldn't be any inheritance tax to pay. In the budget, they announced that they are going to reduce that to £1 million per individual. And then over and above the £1 million, so you'd get 100% relief on the first million. And then essentially over and above that, you would pay a reduced amount of inheritance tax at 20%. So quite a huge change to business owners and family business owners. Of course, there was a bit of uproar. And then randomly in December, they published a guidance note to say that they are going to increase the relief from £1 million at 100% per individual to £2.5 million per individual. Okay. So if you have a small business and the shares are valued at below or on and around £2.5 million, then assuming it's a trading business, it would qualify for 100%, still qualify for 100% business property relief. Of course, if you have a larger family business, then you're still in a bit of a pickle, because over and above that £2.5 million, your shares are going to be subject to inheritance tax at 20%. So this is the change from the 5th of April 2025. Now, of course, we still have a few weeks to look at the old plans. The old plans, which we're currently in, sit at 100% relief. So what that means in reality is that any transfer of shares from an inheritance tax in lifetime perspective, whether that's to your children, to your spouse, to other family members, to a trust, you can look at qualifying for that 100% relief. There is anti-avoidance in place, which was published a few years ago, to say that, okay, you can qualify for that 100% relief, but then if you died within that 7 years, the new rules would apply. But ultimately, it's about safeguarding the position as much as possible today. So that's something to really consider if you are a business owner and you do have family, and you may not have ever considered having an inheritance tax issue. You now may do, and you should probably look at some immediate planning. Now, of course, business property relief, you still need to meet the conditions of business property relief and continue to meet the conditions of business property relief in order to qualify for the inheritance tax. These will include the basics around it must be a qualifying trading business, must have owned the shares for 2-year minimum requirement prior. It must be wholly or mainly trading. So this is essentially broadly a 50% trading test. And when HMRC will look at trading, they look at things like the turnover split of the group or the business, the profit split of the business, the capital where that's being employed, the management time, whether that's going to be mainly used within the trading business or essentially the investment business. Some areas of risk that you should be considering is excess cash. Excess cash, if you have too much cash in the trading business over and above the usual requirements for working capital, so it's important you keep the working capital logs on any given year, then HMRC could look at if you've got excess cash over and above the working capital and say, actually, you're now dipping in to becoming an investment business because you're holding on to cash. Residential property ownership mixed within the trading group. Residential property is predominantly classified as investment usually, so be careful about that. The asset values, and if you're continuing to invest in residential property, maybe look at segregating the businesses and the group. Yeah, and those are the core points which I think should be considered. Just a couple of notes in case you missed it. There's a highlighted chat, which you can see. It says https://bit.ly Fusion Tax Consult. If you want to click that, you can essentially book in a meeting at your convenience. So be a calendar drop down with my colleague, who will then talk to you about what your private matters are, or what you'd like to talk to me about, and then he'll book something in my diary for me and you to have a one-to-one consultation at no cost. And as mentioned, I'll be covering some questions towards the end of the webinar. Thanks for your patience. We're working our way through. Probably got about 15 minutes to go. Okay, some basic points just on the capital gains tax. So the annual exemption, £3,000, obviously decreasing. So may want to look at that per individual, particularly if you've got investment accounts. Again, maybe speak to your banker or financial advisor. One thing that I do often get asked is about the utilization of losses, capital losses, which is quite interesting. Just to note really that with a capital loss, so a capital loss is if you've made an investment and you've made a loss on that investment. So that may be in your stocks and shares portfolio. It may be to do with cryptocurrency. It may be a investment property that went wrong. Then these losses, it's important to keep a note of them, because these can be carried forward indefinitely against future capital gains tax. Okay. Obviously, again, utilizing your spouse or civil partner. So that might be useful. And of course, looking at where was I? Sorry, I just had a call come in there. Looking at the date of disposal. So if you're working on a transaction now, you want to try and conclude that most likely by the 5th of April, so you can obviously shelter the capital gains tax rates within this tax year, which brings me on to business asset disposal relief. So business asset disposal relief, it's still at the £1 million level. So this is where you've got a qualifying business or shares within a business that qualify, and you sell the shares. Then on the first £1 million, you would qualify for business asset disposal relief. and it essentially means that you'll pay capital gains tax at a reduced amount of capital gains tax rates. So previously that was 10%. It's now been increased to this tax year at 14%. And if you look at the next tax year, so if you go past April, that will be at 18%. So if you are looking at a share transaction, you may want to look at saving that 4% by concluding that by the 5th of April. Just some basic points on business asset disposal relief. So there has to be a minimum shareholding. You have to have 5% of the shares and the voting rights. It obviously has to be a trading business. You have to be an officer or an employee broadly. So it's always good just to double check that you annually meet the conditions for business asset disposal relief. You know, we're hoping under another government that, you know, this relief could be slightly more generous than similar to what it used to be. Okay, a big area which I've got a couple of slides on, and there is no magic wand, is around property. So we appreciate that investment into property, investment properties nowadays is tremendously challenging. Not only does it bring across every single tax exposure there is, income, CGT, SDLT, IHT, potentially corporation tax, VAT at a higher level, there is a tremendous amount of legislation and compliance which now is affecting property investors. And, you know, there is no real magic wand. What it comes down to is, you know, essentially just hard modeling. Do you want to continue within your portfolio? What is your tax and lifestyle position over the next 10 years? Can you move the portfolio into a limited company? What is the outright costs of doing that? Capital gains tax, stamp duty, finance costs, legal costs. Can you sell the portfolio? Is that better? And then invest in the money elsewhere. A lot of our clients are getting fed up and just getting out and selling their portfolio. Of course, if you own your portfolio within a limited company, there could be interesting opportunities to sell the shares of the company itself rather than the assets and potentially save some tax there. Still fair to say on an assumption basis that if you just look at the tax rates and if you don't need the monies to live off personally, then from an investment hold perspective, from a rental income perspective, then it's still more tax efficient to own rental properties within a limited company and shelter the funds within that company. Because of course you pay corporation tax on the profits, the real profits, because you can still deduct the mortgage interest against the rental income. Whereas one of the biggest issues in owning a property personally is that when you go above the basic rate band of income tax at that £50,000 mark, you can't deduct the full amount of mortgage interest. This creates artificial profits, which creates higher taxes in which you have to pay. And how are you going to fund those taxes? Because they can't come out of cash flow. So I really do sympathize with property investors and the conundrum, and there is no magic wand. Just a quick point here. If you sell property personally and you make a profit, you need to report via an additional capital gains tax return and submit that within 60 days of the sale. So just bear that in mind, often gets missed. Just wanted to cover, we still get a few inquiries from landlords about incorporating. So incorporating essentially means that you have your personal portfolio, which is owned in your individual names, and then you'll look at essentially moving that to a limited company, and you're trying to look at claiming what's called incorporation relief. So that means that if you are able to claim incorporation relief, there'd be no capital gains tax on the gift from your own names to the limited company. And of course, this is an area HMRC are looking into and have looked into now for a while. And unless you are generally running your portfolio as your main income, as your main business, then I would say it's unlikely to qualify for incorporation relief. Incorporation relief was brought in to essentially get relief from a sole tradership business, and they've grown and they commercially want to convert that into a limited company, right, and essentially not pay tax on doing that. So HMRC don't want people taking advantage of that. So if, for example, you're employed and you have 2, 3, 4 investment properties, then I would say it's highly unlikely if you were to move those properties into a limited company, you would be able to qualify for incorporation relief. So let's look at another sort of scenario whereby if you have a property business whereby you have 30 buy-to-lets, upper, lowers, shops, all this type of stuff, you've run it for 20, 25 years, it's your main source of income, it's your main business, then yes, I would say you would have an opportunity to look at claiming incorporation relief, moving the properties into the limited company and claiming that relief from a tax perspective. But even then, you need to understand that it's a very complex piece of legislation. Broadly, what it says is that it needs to be a all or nothing relief. So what that means is that you can't leave anything left behind. So that means all the properties within the business will need to go in. You can't pick and choose. But also you can't forget things around like debt. So let's say the debt is in your individual name, you'll have to look at rebrokering that into the name of the new entity and everything in between. There's also planning around, partnerships into limited companies. Just bear in mind, it's 2 separate reliefs. Just because you have a partnership, most typical partnerships are, say, husband and wife, 50-50 owners, they are in a partnership, doesn't mean that automatically, if you run that partnership for 3 or 4 years, you automatically will qualify for incorporation relief. The partnership element is around stamp duty. So where you incorporate a partnership, then potentially you don't have to pay stamp duty on that incorporation. But it's 2 separate reliefs. And there's a lot of anti-avoidance now on particular LLPs, partnerships into limited company. So, of course, it's a minefield. There's no easy wins. If it sounds too good, probably is. Need to get some careful analysis done. It's one of those things that you just need to do the numbers, be cautious, be sensible, and seek appropriate advice. Okay, so moving on to the final couple of slides where we talk about family. So family investment companies are very interesting. This is essentially what I was broadly talking about in the first couple of slides around the group. A family investment company broadly is a limited company which owns the shares in the other entities that you may have. It could be an investment entity. And essentially you have the parents who are the shareholders and the adult children as well. And also it could also have shares which are owned within a trust. Now this helps with essentially freezing some of the value of the assets. It helps with inheritance. It helps with passing on to the next generation. You can look at different classes of shares for the children and the trust in terms of voting and dividend rights, and it could all be governed by a family shareholders agreement. So this is something that we look at, particularly at the top of the holding layer of business owners and family business owners. Of course, over time, the key thing will be from the parents to transfer more of their shares to their children and look at essentially value shifting and long-term tax planning. I mentioned trusts. So trusts are essentially becoming more and more important when it comes to family planning. A trust in itself is a separate legal entity, and it's pretty much there to protect the family bloodline. It's the only real piece within the UK legislation that can help operate that. So when we're talking about protecting the family bloodline, we're talking about things like divorce, bankruptcy, and protecting it through the next generation. So for some families, that is over and above tax, that is of utmost importance. And it can be that actually within the share structure, you can look at having some shares within the trust. It could be that you can put maybe some of your property investment into a trust. Broadly, in terms of the trust, you have the set laws, who are essentially usually the parents. They sort of govern what the trust is made up of and what the trust can and can't do. You have these trustees, who essentially govern the day-to-day operations of the trust, which is usually the parents in lifetime, and the beneficiaries, which are the children. Now, of course, there's loads of taxes as well to consider within the trust, which you need to consider. There's a 20% entry fee on the trust for assets over and above the nil rate band, 325, 650 if you have two people setting up the trust. There's a 10-yearly charge at roughly 6%. Exit charges are there. And of course, there's income tax on the trust itself. So again, it's not a magic solution. You have to be very agile when we're talking about family planning, going into depth about what the trust can and can't do and why that's important within your mix. But when we look at the interaction between what we spoke about previously, business property relief, and the transfer of assets, it could be worth looking into that, because even if you have assets above 650 in terms of shares, then it could qualify for business property relief within this year. So there wouldn't be an immediate entry into trust. So lots and lots to consider. In all honesty, most of our clients will look at a hybrid of all different types of planning, and we'll model it out and maybe look at a 5-year plan and then tweak that every 5 years. There's no real one solution to look at. Also, a lot of our clients at the moment are looking at protecting against their inheritance tax liability via some life insurance product. Depending on your age, it could be the usual type of product up to 65. If you're older, you can look at a whole of life product. If you're a business owner, you can look at something called relevant life, which is essentially where the business can pay for the life insurance product itself without there being an actual benefit in kind tax charge. So it may be worth speaking with our financial planners as well, because it may mean that when we talk about the agility of tax advice, we come up with that initial plan that might get you to, say, a 60% efficiency. We cover the remaining IHT exposure for a period of time and then reduce that in accordance with the plans. So yeah, lots to consider before the year end. Absolutely. Okay, so some final points to note. We spoke about the review of your income distribution strategy, disposal triggers, review of your business structure. Really important. Can you expand that? looking at business property relief. Do you have an exposure to business property relief, to inheritance tax, and look at what can be done to shelter the business property relief? Consider trust, look at your pension contributions, share transfers where relevant, life insurance to consider as well, and property investment modeling. Lots and lots to do. We'd be more than happy to speak with any of you that need help. Absolutely. You can see the link in the chat, and we can book in a free consultation. You can also see my email address on screen, mitch@fcg.co.uk. Cool. So that was hard and fast, and hopefully you got lots of points to consider and act upon. I'm now going to look at some questions and provide you with some answers if I can. So let's go through. So yes, nice easy one. Yes, the webinar is being recorded. Yeah, so we've got some questions about a crypto loss. So I've made the loss. Can I use that indefinitely? So yes, assuming crypto is often a strange one. There's lots of sort of tax elements to it, but broadly, you've got to look at, is it an income tax loss or is it a capital loss? If it's an investment and crypto isn't your main trade, then it's likely to be classified as a capital loss. And then, yes, you'll be able to document that loss and then use the capital loss indefinitely against future gains. Thank you for your question. We currently are a family of 3 and own personally commercial property that generates £130,000 of income per year. Is there something we should be looking at reducing our personal tax? Yep, thank you, Emma. And yeah, absolutely. I would look at the alternative options in terms of what's available to you. Does it make sense to maneuver the properties into a different structure? Depending on the levels of income that you need, it may be more tax efficient to do that. In terms of your exposure to income tax, and I'm assuming you have payments on accounts to make and everything else. So you'll just need to do the modeling as to transferring that probably to a company over and above, keeping it as it is. Also depending, of course, on what your long-term plans is for the properties as well, whether you're going to keep them or sell them. Thank you for your question. Yes, a good point here from John, who says mortgage lending is often an issue with a holding company structure. Do you have alternatives? Well, I mean, what I would say is that yes, there are some lenders who, mainstream lenders, or certainly like the real estate, the buy-to-let lenders, mortgage works, etc., who don't like or understand what's called a multi-tier structure. So depending on who your lending is, it certainly is worth speaking to them. We have worked with banks in the past who do understand the multi-tier structure, and there are options available for every investor out there. Of course, the rates might be different when you have a company structure to a individual lend, but it's about weighing up the pros and cons, and this is where all the analysis comes in. Thank you very much for your time. I will be, of course, having some more webinars and seminars throughout the year, so please do look out for our marketing throughout the next few weeks and months. If you've enjoyed today's webinar, then feedback is great. If you'd like to write a Google review or something, that's also great. And yeah, hope you enjoyed it, and I will see some of you soon. Thank you very much.